welcome to another session, ID to IPO, Silicon Valley. We're doing a presentation today on how to do a venture capital financing. My name is Alidad Vakili. I'm an attorney with Foley Lardner. I know people are still joining, so it's just 9 o'clock now. I thought we'd give it another minute or so, and then we can get going. So appreciate the patience, but let's give it another minute, and we will go ahead and dive into the topic of how to do venture capital financing. For those of you that are already in and waiting, there will be a link that'll be circulated probably a couple of days after this presentation. We need to kind of go through and prep it, and then what we'll do is we'll send the link out. So if you need to leave a little bit early, or if you joined late and didn't get a chance to see the full video, no fears, no worries. You will definitely get an opportunity to view the link once we have it ready and sent back out to you. Okay, it looks like we got a few more people joining, so let's give it another 30 seconds and then we can go ahead and get started. I know in the past when I've done these, there have been people that have joined from all over the globe, including Asia, Australia, South America, Africa. So for those of you in different time zones where it's either super early in the morning or late at night, really appreciate your taking the time to attend. Thank you for that. Okay, well, why don't we go ahead and get started? It's a little after 9. My name is Alidad Vakili. I'm an attorney with Foley Lardner. We are going to be talking today about how to do a venture capital financing. It's a topic that's near and dear to my heart. I'll give you a little background on myself and Foley Lardner. We'll discuss the agenda, and then we'll dive into some topics, hopefully of interest to all of you. Next slide, please. So very quick housekeeping matter. Just keep in mind, I'm going to be talking sort of very high level about concepts and issues that come up when a company is going to be doing a venture capital financing. So please don't take anything that I say as legal advice. It's not intended to be legal advice. It's really more educational. This is an educational program. I am happy to talk to you or correspond with you via email if you've got some specific questions after this program. I will include my email on the last page, so you'll have that to look at. Reach out to me if you've got any specific questions. But I won't be discussing any specific fact issues today that you might have, just sort of general information. Next slide, please. So here's our agenda for today. We've got a lot of material. It's pretty packed. I'll try to get through it as quickly as I can and leave room for some Q&A at the end. We've gotten some great questions in the past. If there's something that I covered that you want to delve into a little bit more, or you had questions about, or if it wasn't clear, please ask. You can put it in the chat. You know, because this is a webinar and we're trying to squeeze everything in within the hour and a half that we have, I'll try to save as many of the questions for the end as I can, and then I'll run through the questions. I will be checking them as they come in, so if I can handle a couple as I'm talking on a particular topic, I'll certainly try to do that. But if you could bear with me, I will try to get to all the questions at the very end. If there's some that I don't get to because we run out of time, just reach out to me separately, send me an email. I'd be happy to chat with you. So I'll give you a little bit of background. We'll talk about sort of overview of the discussion for today, some structural considerations of, you know, what you set up, where you set it up if you're setting up your company, important documentation in the very beginning stages of your company for founders and early personnel to be thinking about. What are some of the financing options that are available before you do your actual VC financing? For example, we'll talk a little bit about convertible securities. We'll talk a little bit about valuation and dilution and why that's important to be thinking about as you're going through this process. We'll provide an overview of the venture capital financing and then getting investment ready, as I call it. So putting yourself in the best position possible before you even start talking to investors, and then how to prepare for closing, and some common pitfalls that I've seen over the years where startups, founders, entrepreneurs can make some missteps and create some issues for themselves that they might otherwise be able to avoid. And then we'll have our Q&A. Next slide, please. Okay, so a little bit about my background. I'm a corporate attorney with Foley Lardner. My practice is focused primarily on working with emerging growth and venture capital investors. It's everything from startup of formation of the company all the way through exit. So once we get to some sort of M&A or exit, then help them with that as well. And everything in between, including helping them raise financing, all the corporate governance related issues, and things like that that come with it. I work out of our San Francisco and Silicon Valley offices. I've worked with companies that have been local to the Silicon Valley area, as well as San Francisco, other parts of the US, as well as other parts of the world. A lot of companies coming into the US have done a lot of cross-border work where we'll help set them up and provide them with a operational company here in the US. Love working with entrepreneurs and founders and investors. The startup adventure is really a great adventure. It's one that takes a ton of time and commitment, persistence, but it's one that obviously has tremendous payoff, both personally, professionally. It can be very rewarding for the founders once they hit a home run and have a really successful exit. And it leads to all this incredible innovation that we have today. And it's a lot of that is because of all of you folks, you founders, entrepreneurs, as well as the investors that are supporting all these endeavors. So it's great to play a small part in that and see all the cool stuff that you guys are developing and doing. Next slide, please. I like to throw in quotes every once in a while because they can, these famous quotes can say things that I could never say in so few words. So we'll focus a little bit on this throughout today's discussion, but preparation is key. I talk about this almost in every single presentation I give on this or related topics, that, the more time you spend on preparing for whatever it is, including the financing, the better it will be, the more successful it will be, the cheaper it will be, the quicker it will be. So I can't overemphasize how important the preparation piece is to a successful transaction. Next slide, please. Okay, a little bit about Foley and Lardner. Great firm, been around a long time. I think we date back to the 1880s or so. So very long history. We are a international law firm. We do basically a full service, everything from corporate to executive comp, executive benefits, to IP, litigation, tax, environmental, energy. I mean, you name it. There's just about nothing we don't do. And we've divided our practice areas into a number of different sections. So we focus a lot on different areas that are important to our clients, like technology, healthcare, life sciences, energy. We have about 25 offices across the US and several offices outside the US as well. Next slide, please. And so you can see a little bit here very quickly on some of the different topics that we cover. I'm not going to spend much time on this, but just the takeaway here is it's really full service. So if you've got questions about anything, not just corporate, feel free to reach out to me. If it's something that we can help you with, I will make sure to get you to the right person and help you guys out however we can. Next slide, please. Okay, so delving into the meat of this discussion, one of the first issues to consider as you're sort of preparing to do a VC financing is you've got to make sure you've got the right entity and that it's set up in the right place. So the two main decision points early on in the startup adventure is what type of entity should I create and where should I create it? What jurisdiction should I be using? I'm not going to spend too much time on this. I can go into some more detail if people have specific questions. But essentially, when you're looking at getting investment dollars from third parties, i.e. angels, but really specifically looking at sort of the venture capital investors, private equity investors, the more sophisticated investors, they oftentimes want or will require that you set up your entity as a Delaware C corporation. Delaware, because Delaware is sort of the preeminent state in the US, where a lot of the companies, the majority of publicly traded companies in the US are all set up as Delaware corporations. And any company that wants to attract VC dollars, if you're setting it up in the US, you really should be looking at setting it up in Delaware. Delaware has a great statute. It's reviewed on a regular basis. It's updated. It's very well written. There's a lot of time and effort put into developing and creating a corporations code that's well written, that sort of balances the management side and the investor side. Very well understood and respected by a lot of the investors as well as a lot of the companies. So that's one reason. The Delaware is a little bit unique in the sense that if there's ever a dispute that arises with regard to the corporation, then there is a special court in Delaware called the Chancery Court. And the judges that sit on that court and who will be deciding those cases are all very steeped in business law knowledge. They usually have practiced business law before coming onto the bench, and that's all they do. They don't do other areas of law that doesn't relate to business or corporate law. So you usually have your case decided by someone with a tremendous amount of experience in that specific area. So that's another great reason. They're also the Secretary of State is very responsive. So you can turn around things pretty quickly, easy to work with them. So for those and a number of other reasons, Delaware is sort of the preeminent state. The entity type being a Delaware C Corp, the corporate form is the oldest form, entity form. When you're looking at a form that can provide you with some liability protection, it's very well known. It goes back, we've got a good, long 200-year history or so in the US. So it's very well understood that the way it's set out in statute is understood as well by the investors. So it's a structure and entity that investors like. They understand it. They're knowledgeable about it, and oftentimes will require that to be the structure that you set up. Next slide, please. Oh, and just really quickly, for those of you, I get this question all the time. If you're joining or joined late, then a couple things. One, this is being recorded. So we'll make the recording available to you afterwards. It may take a couple of days, but we'll get it out to everyone that registered for this presentation. So you'll have a chance to view the recording if you didn't view it or if you came in late or need to leave a little bit early. So don't worry, it will be available for you. The other topic that's really important as you're looking to set yourself up and to do a VC financing, and this applies to any kind of financing really, but I know that today's topic is really focused on VC financing, is documentation for founders and early personnel. So your very early documentation with regards to your company is really critical. That's sort of the foundation. If you do it properly, consistently, then you've set everything up the right way from the get-go, and it's very easy to maintain that process going forward. Because as the company grows and expands and scales, you'll have a lot more documents, you'll have more financing rounds, but setting everything up, having the right documentation in place early on is going to be really, really important. Yeah, so I just saw a question. We will definitely share the recording. It will be made available probably in a few days after this presentation. So on the topic of the early documentation, so I mentioned it's key. You want to make sure that you've got in place, the company has in place a number of different agreements, but those should cover confidentiality. So if the founders are going to be talking to anyone that they want to maybe bring into the company as an advisor, an employee, consultant, maybe even early discussions with who might be potential customers, you just want to make sure that you've covered whatever sensitive information you may be disclosing. You want to make sure you've got some sort of confidentiality agreement in place to cover that. Now, one thing I'll note, when you're working with VCs and other investors, but especially VCs, don't ask them to sign a confidentiality agreement because they will not sign it. They see hundreds and hundreds of business plans and slide decks, on a monthly basis. And if they were to try to sign a confidentiality agreement on every one of those scenarios, they'd be dealing with tens of thousands of them over time, and it's just impossible to manage. So they typically will refuse to sign a confidentiality agreement to have an initial meeting. You don't need to disclose the secret sauce at that initial meeting, but they typically will not be signing any sort of confidentiality agreement. But anyone else you talk to certainly should be thinking about it and have one ready to go. The other agreement that's really important, and especially for founders, but also early employees, consultants, advisors, is what we refer to as an intellectual property assignment agreement. It's got a couple different acronyms, CIIAA or PIIAA, which stands for Confidential Information Invention Assignment Agreement. I know it's a mouthful, or Proprietary Information Invention Assignment Agreement. Those cover confidentiality, but they also cover something really critical, which is if you've got someone that's coming into the company to develop something for you, to create something, to code what's going to ultimately be the software that's going to run the platform or the company business, or they're creating something else that's got value that's going to create some IP. You want to make sure that that's all transferred over to the company so the company owns it. And the way to do that is by having one of these agreements in place. So it says essentially whatever they're doing that relates to the company is going to belong to the company. So if you bring in a developer and they're writing the code that's going to be sort of your main code for running a bunch of applications that are going to be critical to the company's success, you want to make sure that you own that code. I'll talk about this when we get to the pitfalls, but one big pitfall is not getting that agreement in place early on. You get someone in that develops something critical technology. You never got him or her to assign it to the company. They end up leaving a few months later after they've created it. Well, guess what? If you don't have it transferred over to the company and you've got no documentation to that effect, they own it. If they created it, they own it. And now you've got someone who basically owns the really valuable core technology you've created, and you're stuck. I'll talk a little bit more about that later on. Another issue to cover is vesting of securities. So when you talk about securities, stock or options, you want to make sure that you've properly incentivized people that are going to be joining the company to work for you, but that you've also got mechanisms in place so that if for some reason someone leaves, you've got a way to repurchase the stock that hasn't vested. It vests over time, so they've got to put in their time before they can take full advantage of the equity that they're getting. And that's one mechanism to do that. It's important for founders too. And the reason being is, if you've got more than one founder and one of the founders decides to leave and they've got 40% or even let's say 50% of the company initially, now they've left, they're no longer participating in helping the company grow, but they walk away with 50% of the company. That's huge. So that puts you in a potential stalemate position with decisions that owners might have to make, because now they're 50% of any vote that you need to make. And if you can't get them to agree, then the company's in a stalemate. It's going to, be unable to move forward. Even if they have a smaller percentage, if it's significant, then there's no value that they're providing to the company going forward. So those are sort of issues that are all important to be thinking about on a going forward basis. And it's important from the investor's perspective because they will be looking for all of these things. They will be looking to make sure that you've got all of your IP assignment agreements in place with everyone, that if the stock has been issued or you've granted warrants or options to people, that the right language is in the agreement, so it is vesting over time, including vesting for founders. Even though if you're the founder, it's your brainchild, you've created it, why should you have restricted stock? Why should you have any of this vesting concept? Because the investors also want to know that when they put money into the company, that you're going to stick around. You're not going to take the money, goes into the company, and then you're like, oh, great, I'm going to take off now. I'm going to go do something else. Because without you, if you're the founder and you're the one that created this, it's probably not going to be a successful venture and their money is going to be at risk. Transfer restrictions is another really important issue to be thinking about early on and having the right documentation, because you don't want someone to get stock in the company and then, a few months later go ahead and sell that stock or transfer that stock to somebody else who may not be interested in the company, isn't involved in the company, can't really contribute to the company. Leaving aside the fact that this is a private company we're talking about, so you got to comply with the securities laws. You can't just go and sell your stock to whoever you want. There's ways to do it to make sure you're complying with the securities laws, but you still want to have some restrictions on place so the company knows at any given time who the owners are, and not wanting to have shares sold to someone who may not be a good person, including, for example, someone wants to transfer their shares to a competitor. Well, great. Now you've got a competitor on your cap table that's an owner. Do they have access to certain information? Are they going to be able to find out what you're doing? Probably not a good scenario in some cases. But anyway, those are some reasons why transfer restrictions are important, and the documentation for that is really important as well. Next slide, please. Okay, financing options. I'm going to cover this kind of quickly because I want to make sure we've provided enough time to really talk about setting your company up for a venture capital financing. But oftentimes before your first VC financing, which is typically when you sell preferred stock to a venture capital fund, you will oftentimes need to be funding it, from the very get-go. And so here are some different ways that you can do that. Obviously, you can bootstrap it, which is where the founders come out of pocket and put money in themselves to cover the initial expenses of starting up the company. But beyond that, oftentimes you can go out and do convertible notes. Oftentimes they're called bridge notes if you're bridging to the next sort of financing, or some other type of convertible security, which may be a SAFE, which is an acronym for a simple agreement for future equity. And we'll talk a bit about that. And then, of course, you can sell stock, which would be, priced equity. And most of the time when you're selling stock to investors, you're going to be selling preferred stock. In some cases, not very common, you'll sell common stock to people very early on. Usually not the best approach, because as you sell common stock, you've now priced the common stock at whatever you sold it to the investor at, which is usually going to be higher than you would want if you're then going to be going in providing restricted stock to employees and advisors and consultants, or granting options to purchase common stock. So there's some pricing issues you need to be careful and sensitive about, so you don't kind of mess things up on that front. But anyway, there's other financing options. We won't really go into grants, loans. Typically not. Loans are not something a startup is going to be able to do because you don't have revenue and you don't have assets typically where you could go get a loan. There may be some grants. I've certainly seen early stage startups that have some sort of cool technology, and whether there's federal or state programs that provide grants to fund that type of innovation, and there are some. So there may be some funding sources from that or from private foundations, but we're not going to go into that. That's beyond the scope of this presentation. Okay, so let's move on to the next slide, please. So let's touch on convertible securities for a moment. So, and by its name, it's exactly that. It's a security that will convert into something else at some point in time. So oftentimes it converts to a future equity at a negotiated discount or some sort of valuation cap we'll talk about at a future qualified equity financing. So some financing that's going to take place in the future. The investors today are putting money in today with this idea that they're going to be able to convert into that security when you go and sell that security in the future. So some of the pros and cons. If you are issuing convertible securities like a convertible note or a safe, that some of the two of the more common type of convertible securities, that avoids having to value the stock. You don't need to come up with a value on the stock today because you're not issuing stock, you're not selling stock today. You're only giving them a contractual right to get stock at a later date once you sell it. So, when you go to sell stock, you need to come up with the value of what that stock is. And so not having to give a value early on might be a good thing because you may want to build your company up a little bit more, maybe, get to the point where you've got more technology, got more value, have more assets, maybe have revenue coming in. And then at that point, come up with the value because hopefully, likely, the value will be a lot higher if you wait and assess it at that point rather than very early on before you have any of that stuff. And obviously, the more value you have, the better it's going to be for the company. So that's one of the pros. The convertible note or the safe instrument or agreement, they're usually generally much easier to document than if you're going to go sell stock. In your typical VC financing, there is a suite of documents that you need to negotiate and get finalized and executed. That takes time. They're lengthy. They're detailed. We'll go into some of that a little bit later. But having a document that's much shorter, much easier to put in place and negotiate with investors gets you money that much quicker through the door, so that you can use it much quicker. And then again, you avoid the valuation and put off some of the other stuff until later on when you are ready to actually sell your stock and do a priced equity round. And of course, it's less expensive. So, to do a convertible note versus, or a safe versus a full-fledged VC financing is going to be a lot less expensive. So much easier given the startup. If you have a limited budget early on, much easier to manage. Some of the cons, at least for convertible notes. If it's a convertible note, it's a note, it's debt. So now you've got debt that's going to be reflected on the financials of the company. It is debt, so it has to be repaid at some point in time. On a convertible note, you will see a maturity date, the date when that debt needs to be repaid. Having said that, though, most investors that are putting money in for a convertible note do not want to get repaid the principal and interest. That's not what they're looking for. They're really looking for an opportunity to get in early, to negotiate the ability to convert their the principal and interest into shares at a future date at some sort of a discount. So they get a better deal than if they just waited and bought shares when you do your priced equity round. So it's attractive for them. It's good for the company too, but just be aware it is debt. And if there are some circumstances where if the company can't raise a round and it's been a year or two or whatever the time period is, depending on what the agreement says, the holders of the note, those investors could come back and say, okay, you didn't raise, we didn't convert, you need to repay us the money. So something to be aware of. Doesn't happen very often, but it certainly is something that could be done. I call it an extra liquidation preference. If they're loaning money to the company in a convertible note, then they are creditors, and creditors get paid first before you can pay shareholders. So debt gets paid before you can pay any of the equity holders. So it's good for the investors because they're going to get paid out first if the company has to liquidate, close down. For the company, just being aware that money needs to go to them first before it can go to other shareholders if the company is going to be closing down or dissolving. Next slide, please. So a little more on convertible securities. See, these are some of the typical terms you'll see. Maturity date is when it's due, when you have to repay the principal and interest. The interest rate, in order to be a loan, a note, it has to include some sort of interest rate. Interest rates, typically are generally pretty low. Obviously now in the current economy and the current landscape, we've seen a hike of interest rates by the Fed. So, obviously the interest rates on convertible notes that we're seeing now are typically a little bit higher than what we've seen in the past. You typically have to set your interest rate at the very lowest. You have to follow what the feds tell you is the lowest rate you can charge, the applicable federal rate. And so those have obviously gone up, over the year or two. So you will see an interest rate on notes. You'll see conversion terms. What are the terms and the mechanisms for when the convertible note converts into stock? That's going to be important. The amendment terms, this is one that is important to pay attention to. If you do a bunch of these, if you go out and raise, $1 million, $2 million on convertible notes, how can those notes be amended? And oftentimes, if it's just one note, it's the company and the person that holds the note both need to agree to some sort of amendment. But if you've got 10 notes out there, and let's say the maturity date was coming due, you issued them today, and the maturity date, you set it for whatever reason, December 31st of this year, doesn't give you a long time to do your financing where those notes will convert. So if you're coming up on that maturity date, the last thing the company wants is suddenly you hit December 31st and everyone calls you that has a note saying, hey, great, enjoyed the ride, now repay me my principal and interest. And you're looking at your financials saying, I'm a startup, guys, I don't have the money, I can't repay you. So you may want to extend the maturity date. So to do that, you've got to amend the agreement. But if you got 10 or 15 of these notes out there, do you have to go to every single one of those 10 or 15 note holders to get their consent? You can include a provision in the convertible note that says, look, as long as we get a majority in interest to amend, then we can amend certain terms, including, for example, the maturity date. So that's an important thing to be thinking about. The remaining terms, not typically a lot of negotiation on those, some reps and warranties and covenants and things like that. I'm not going to go into too much detail here, but just know that these are some of the basic terms you'll see in a convertible note. These don't apply to safes, by the way, which we'll talk about in a moment. Next slide, please. So other topics on convertible notes, mandatory conversion at a discount price, pay the next qualified financing. So essentially, as I mentioned, they're designed to convert into shares when you do your next financing. And you typically want to make sure you've got a good definition of what that next financing is, at which time those notes will convert into equity. You don't want to leave it open-ended, and you can, but oftentimes we'll see a defined term. So for example, you have to raise at least $1 million by selling preferred stock. And at that point, that triggers, that's the definition of next qualified financing. That then triggers the conversion, and they'll convert at that point. Oftentimes you'll see a discount or a conversion price cap or valuation cap. And essentially what this is, I'm not going to spend too much time going into it, but they're getting some sort of a sweetheart deal in the sense that when the note converts, it's going to convert at a discount to what the investors in that financing are going to be paying for their stock. So for example, if you're doing a discount, a 20% discount, and when you get to your next qualified financing, you're going to sell preferred series, or let's say Series A stock at $1 a share, they're going to be able to buy it for 80 cents a share. They're going to get a 20% discount off of that dollar. So for them, it's a good deal because they're going to end up buying it cheaper than the other investors. There's a concept called valuation cap, which essentially does the same thing. It'll give the note holders the ability to buy more shares by applying the valuation cap. And it's a way to basically say, we're going to establish what the valuation cap might be now. Let's say it's 5 million. And if you go to your next qualified financing, and let's say at that point in time, you've come up with the value for the company of 10 million, then when you do the numbers in the equation to figure out how many shares their note will convert into, you don't use the 10 million figure, you use the 5 million figure. So it's going to be less, which means it'll translate into getting more shares, which means they're getting a better deal because they've got this valuation cap. Conversion upon a change of control. If the company gets sold before there's a next qualified financing, there'll be mechanisms for managing that. It can convert upon certain terms. Or if the company just decides that it's liquidating, what happens then? There's usually provisions for that too. In some cases, you'll see optional maturity conversion. So when the note comes to maturity, instead of demanding to be repaid the principal and interest, the note holder or the company in some cases can just go ahead and elect to convert it into shares using some formula. That's another provision you might see from time to time. Next slide, please. Okay, so the topic of capitalization, let's talk about that for a moment. This is an important thing to be thinking about all along the life cycle of your company. It's important in the beginning because you want to make sure you're setting things up properly. But how much equity do you give? How do you allocate equity? How do you strike the right balance between parceling out equity in the company at the very early stage, i.e. amongst founders, or even as you're bringing employees on, advisors, consultants? How do you allocate that? So people are incentivized. They want to be productive and help the company grow, but you're also not giving out too much. So the founders end up getting diluted and having a lot less than maybe they might otherwise have. I always tell people, think backwards. So think about where you might be in 3 or 4 or 5 years. Think about what that might look like, what you want to ultimately have, or at least try to have as far as an ownership in the company, and then try to work your way backwards to figure out, okay, how do I plan for that? If I want to make sure I've still got control in a few years or more, we'll talk about that control feature with VC financing, then what do I need to do to make sure I'm not being diluted too fast, too quickly, too much, so that within a year now I'm kind of close to that majority ownership position? How do I manage that properly? That's going to be important to be thinking about. So there's sort of two pieces to that it's important to think about is the actual ownership. So you own 51, 50, 60, 70% of the company, and with that comes voting rights and the ability to make decision and control. But also with that comes the economics, right? So if there is a ability to disperse proceeds that come in, if you sell the company at that point in time, what are the economics going to look like if you have 70% versus 50% versus 30%? So those two things are something you want to make sure you keep track of as you're going along the life cycle of the company. And they'll change from time to time, but understanding them at any given moment is going to be important so you can plan for it. Dilution will definitely happen, so you just have to be aware of it. Anytime you issue stock, anytime you grant options as a founder, you have to realize that at some point in time, you're either going to get diluted immediately if you're issuing stock, or you will be diluted in the future if you're issuing options. And once those options are exercised and the stock purchased, at that point in time, there'll be a dilution of what your ownership is. And of course, the biggest dilution occurs when you go out and raise financing, and it's typically going to happen when you start doing your priced equity rounds. And now you've got VCs coming in and investing significant sums, and they're going to want a significant percentage of the company. All subject to negotiation, but oftentimes they'll have a certain amount that they're looking for. It could be 5, 10, 15, 20, 30% or whatever of the company for their investment. So that chunk, once it goes out to them, obviously that's going to dilute the founders down pretty significantly. So planning for it's going to be really important. Incentivizing your team properly, just making sure that you've got employees, consultants, advisors, you're giving them what is fair, what is going to keep them incentivized to be productive, to be really engaged and work to making your company as successful as it possibly can is going to be really important. And then, of course, back to the topic from the very beginning, important to have proper documentation. So make sure you've got vesting rights, make sure you've got repurchase rights, so that if anyone leaves early on, I'm not talking about investors, I'm talking about specifically early personnel, advisors, employees, consultants, including founders, that if someone leaves, that the company has the right to repurchase those unvested shares without them having to take off with a chunk of the company. Next slide, please. Yeah, just really quickly, question come in. The slides will be available. There'll be a link available to view this. So give us a few days, we'll get it out to you. But yeah, you'll be able to get this material as well. So some foundational basics, valuation dilution. We talked a little bit about that. This is important, important early on, but it's also really important as you're getting ready for your VC financing. Understanding some of this terminology. So I'll explain it a little bit here. Pre-money valuation, for those of you who are not familiar with what that means, it's basically just the value of the company before the next round of investment. So let's say your company's, got some assets, you've got some IP, you've got, let's say it's a SaaS-based business and you've already got everything kind of ready to go. You don't have any revenue yet, but you've got technology that's been built and can be commercialized with some funding to be able to finish it up. You're going to come up with a pre-money valuation of the company. So what is the company worth today before your investors have put money into it? And the next term that's important is the post-money valuation, which is really, it's the pre-money valuation after the round of investment. So after you've taken the money in from the investors, let's say you've gone out and you've raised your first VC financing and you raised $1 million, and the value came up, pre-money valuation, let's say, was $5 million for the company. You took in $1 million, your post-money valuation is now 5 pre-money, 1 million investment. So your post-money valuation will be 6 million. Issued and outstanding, what does that mean? If you're looking at ownership, you're looking at the cap table. When you want to see who owns what piece of the company today, then you look at what is considered issued and outstanding. What stock is actually issued and outstanding today? What stockholders are on the cap table? That's issued and outstanding because it's actually been issued and it's currently outstanding. Someone's holding that stock. The other one term that's really important to keep track of and think about is what fully diluted basis, which is different than your issued and outstanding basis. So fully diluted means, let's assume all the convertible securities have been converted into stock. So if you have, specifically, oftentimes it's options that have been granted. It can also include convertible notes. So you take all of that and you say, let's assume everything was exercised and purchased, everything was converted into shares. Now we've got a total fully diluted number of shares that are on the cap table. That's going to obviously be different than your issued and outstanding basis because now you've factored in all of these options that were granted because you've assumed all those options were exercised and the shares purchased. So for example, if you had 10 million shares issued and outstanding today, and you had 1 million shares that were options, granted as options, if those were exercised and the shares purchased, now you've got a total number of issued and outstanding on fully diluted basis. You would assume you've got 11 million shares versus just the 10 million. On an issued and outstanding basis, it's just looking at what's issued and outstanding. So in that example, it would be 10 million. Next slide, please. So here's a simple example. Not factoring in the option pool or any other convertible security. You look at pre-money valuation of 10 million. So you've got 10 million shares that are issued and outstanding equally to 3 different founders. So each founder has 3,333,333 shares, or 33% of the company. If you've got an investment coming in of 3 million at $1 a share, so it's 10 million, right? Your pre-money valuation amount divided by the total number of issued and outstanding shares, 10 million. That gives you your post-money is going to be 13 million, but that gives you your price per share of $1. So founder A has approximately 25%. They had 33% before, but when this new money came in, they got diluted down to approximately 25%. And if you do the math, that you take the number of shares that they currently have, you divide it by the post-money valuation amount, the 13 million, and then you come up with the total percentage that they have. Next slide, please. So here's another example, but now we're talking about convertible securities. So if you had a $450,000 convertible security with a 25% discount, then the holder would receive 600,000 shadow shares or shares. I'll explain that in a moment. And here's the math. Basically, it's 450,000 divided by what the 25 cents times $1. That'll give you approximately what the percentage is going to be and the number of shares. So that's one example where you've got a discount. And the other example below that is where you've got the same amount of an investment in a convertible security, but now instead of doing a discount of 25%, you're giving them a valuation cap. If you remember, I told you what the valuation cap is earlier, of 5 million. So if the value of the company was 10 million and the valuation cap that this person's getting is 5 million, when you do the math, you divide their investment using the 5 million valuation cap, they're going to end up getting more shares, 900,000 shares versus 600,000 shares if they had a discount. So the only reason I'm illustrating this is, and I know I'm going a little bit quickly over this example, is I just want you to be focused on when you're going through and talking about issuing convertible securities where there is either some sort of discount or some sort of valuation cap, really think through. And actually, I would encourage everyone just pull out an Excel spreadsheet and run some scenarios, because you can see clearly in this scenario, giving someone a valuation cap like this, in this example, gives them a lot more shares than if you just gave them a discount. So, obviously, the more shares that are going to be issued, the more dilution on the founders. So as you're keeping your focus on the dilutive impact of the founders, these are some of the decision points that are going to be important. Next slide, please. Okay, so we've got about 20 minutes left, and we're now sort of getting into the topic of overview of venture financings. I've been sort of sprinkling in the concept of venture financing and some of the issues that are important to think about as we've been talking. But I want to kind of take a moment here and just kind of go through an overview of the venture capital financing so you have a better picture of what it looks like and what you need to have. So some of the things that are important is obviously you need to have a credible business plan. So think of it this way, and I'm sure all of you probably already know this and can appreciate it. The venture capitalists, they're in the business of investing and making money for their limited partners that have invested with them. So after a while, they're usually pretty seasoned. They're usually really good at assessing sort of how a company's going to do and whether there's going to be a good investment or not. So you need to be able to come to them and pitch them with what is the most compelling case for why they should invest with you. So your business plan needs to be credible. It needs to be really well thought out. It needs to be really well drafted and presentable. It needs to be concise, and you need to really perfect your pitch. So I would encourage everyone to practice it. There's all sorts of organizations where you can go and do, enter pitch competitions. Some of them have some sort of prize at the end, some don't. But the benefit is just going through that over and over and over again in front of different audiences and getting feedback. So you now have done it 20 times, 30 times, and you've been able to anticipate a lot of questions that you maybe didn't anticipate before. And now you're able better to answer those questions. But you've also got it down so you can be very concise and direct, give them all the information they need. We'll talk about that in a moment, and make it really easy for them to understand the business, the technology, the proposition, and really importantly, because they're looking to make a return on their investment, you need to be able to tell them how they're going to be able to make a return on their investment. The next thing that's really important is running sort of what I call a systematic process. So make sure you've got enough capital from your earlier rounds, whether you've bootstrapped or you've issued convertible notes or safes or whatever the case may be, but you've got enough capital to get you through to hopefully closing your first price equity round, your venture capital financing round. Connect with the right investors. Make sure that you do your homework and your research on your investors. I oftentimes see founders that haven't been through the process think of it as sort of a one-way street. Well, I need to be able to impress them. I need to be able to sell them on my business. They're not thinking about, is that the right investor for me? They're not thinking about the other side of the street, which is I need to interview them as well. I mean, yes, I know I need cash, so I need them more than they really need me, but you need to make sure you've got the right fit, because if you're pitching to the wrong investor who's not in your space, doesn't understand your technology, you're just wasting your time, because most likely they're not going to be the right person. But equally important is to find the right fit, sort of right relational or chemistry fit, right? You want to be working with people that you genuinely want to work with, that you get a sense that they really believe in you, they believe in the company, they're interested in the company. That it's a relationship like anything else. So if you're going to be working with them, make sure it's someone that you really enjoy and want to be working with. Understand your ideal term sheet. We'll talk about that in a moment. Prepare for thorough diligence. If you haven't been through the process before, when you get to your first venture capital financing, that'll probably be the first time that you will go through, sort of a very detailed diligence process, because they're going to be asking a ton of questions. They're going to be wanting a ton of documents. They're going to be turning over every stone. And if you don't have things set up properly, they're going to be asking questions. And in some cases, if it's really messy and bad, that can turn off the investor and either delay closing until you clean everything up, or in some cases, they might just decide, look, this is just too messy. You can't run a company properly. I'm out of here. I'm not really interested. So all the more reason to make sure you've got everything ready to go, so that the diligence process can be as easy and smooth as possible. Have good corporate hygiene. And what do I mean by that? I really mean making sure your documents are clean. That, if it's been a final signed document, you've got a fully executed, dated document. You've got it in a format that's easy to find. You've got the name in a way that it's easy to see what the document is. Believe it or not, I've had some deals where we're looking at documents and, they've called documents, they've called an agreement a note, or they've called a memo an agreement. And so, we have to go and open up every single file. We can't really tell what it is by the name. It just takes more time. So thinking about all that, how to make this as easy as possible on you, but also on the investor and the investors counsel. Believe it or not, it'll help smooth things over, make it quicker, and ultimately less costly. And then be prepared for cleanup. So if you haven't done things properly, and if you haven't gone through the process of having someone like your corporate lawyer go through and make sure you've done everything properly, then just be prepared. There may be things you need to do to clean up before the investor is going to be signing off on the diligence saying, yeah, everything looks good. Next slide, please. So a little bit more on the overview of venture capital financing. It all starts with obviously getting to the point where you've got an investor that's interested to sit down and talk to you. But the real part of the process, the real transaction starts once you've got a term sheet. And whether it's a term sheet that you've prepared and presented, or whether it's one that they've prepared and presented to you, making sure you understand that term sheet is really crucial, because going back to what I said earlier, they've done this over and over and over in many cases, probably hundreds, if not thousands of times. So they know how to negotiate term sheets. They know all the terms. They know everything about the term sheet. And if you don't come to that meeting prepared, you're going to probably miss some things. You won't be as equipped as you could be to negotiate the best deal for you and for the company. So I always encourage people is get a lawyer involved as early as possible, but definitely before you start negotiating your term sheet, because we can help you understand terms, understand what's market, understand how to negotiate certain things, what's important, what's really not that important, and help you with that negotiation process. Believe it or not, oftentimes I get involved. The first time they call me is like, oh, hey, I got a term sheet I signed. We're ready to go. Can you help me? Of course, yes, we can help you, but you've already negotiated a lot of these things. And if you've negotiated something that's bad, it's unfortunate. We could have maybe potentially negotiated something better, but we have the term sheet, and we're working with that. So understanding your ideal term sheet. So how much the company is being sold, what are the dividends that the investors might be looking for? What sort of liquidation preferences are they going to want? Voting rights, protective provisions, which essentially are provisions that'll be baked into the certificate of incorporation, the charter, if you will, that requires the company to get consent from the shareholders or certain series of shareholders or certain group of shareholders in order to do certain things. They're protective provisions because they're designed to protect the investor's money. So they're usually important enough events that if the company could just go willy-nilly make those decisions without getting the investor's approval, they potentially could do something that might jeopardize the investor's investment. So for example, one of the big ticket items is selling the company. So oftentimes the VC investors coming in investing will want to make sure that someone at that sort of Series A shareholding level has some say-so on whether the company is going to be sold, because of course that could tremendously impact the return on their investment. So those are sort of the things that you might expect in protective provisions, optional and mandatory conversions. So keep in mind, and we didn't talk about this in a lot of detail, but there's different types of shares that you can issue in a company. The two main flavors are common or preferred. Preferred is a type of convertible security because typically the preferred will convert into common at a certain point in time. Maybe it's in connection with an exit, a sale of the company, or some other event, but it has a feature to convert. And you'll see in the term sheet sometimes, but certainly in the main documents, there'll be language that'll talk about, can the shareholders decide to convert at any given time, or is there some sort of trigger that will require the conversion of the preferred into common? And that's usually covered, and it's pretty standard, but how those terms are drafted can make some difference. Anti-dilution protection, is there something in the documents, in the term sheet, that talks about the investors having the ability to keep their level of investment? So for example, if you've got a VC that invests and they're getting 10% and they want anti-dilution protection, do they have rights to then be able to maintain that 10% if you go out and issue more securities in the future? I mean, that's one type of anti-dilution protection. There's other ways anti-dilution protection can get built into the documents and the agreements. And there's oftentimes, for example, if you go out and sell shares at a lower price point than you sold to this particular VC investor, then there's a mechanism in the agreement that says, well, then you got to basically offer either to go back and give them more shares to account for that lower price that you're selling now, or an opportunity to buy more shares, and to basically make sure that they're not being unduly diluted. It gives us some protection. Vesting for founders, as I mentioned early on, they're going to be looking at whether or not the founders' stock is vested, so that the founders will be sticking around for a while. They don't just jump ship once the money comes in. Documentation is key. They're going to be looking at that. So that'll be part of the diligence process. Attorney's fees. Oftentimes in the term sheet, you'll see what the investor expects the company to pay for their legal fees. It's usually capped at a certain amount. Depends on the round and how complicated it is. But, you want to pay attention to that. That sometimes can be negotiated. But that's something the company's going to have to pay. So just be aware, not only do you have to pay your own attorney's fees, but oftentimes you'll have to pay the fees of the lead, usually the lead investor, up to a certain amount. No shop and confidentiality provisions. Essentially, that's where there is some exclusivity. You can't go out, once you've signed a term sheet that has a no shop or exclusivity provision, you can't go out and start shopping to sell the company or do something that would impact their ability, the investor you've been talking to, his ability to invest in the company on the term sheet terms you guys have been discussing and agreed upon. Confidentiality, that's another provision. Usually you'll see the no shop, confidentiality, and maybe a couple of other provisions will be binding versus the rest of the term sheet will be non-binding. So, you don't typically want to have a fully binding term sheet because there's terms in there that are not fully fleshed out. And that's where you go to the definitive agreements, where those documents will provide all the details for the transaction. You don't have time to put all that into the term sheet because then your term sheet would be hundreds of pages. So you do sort of very concise, short summaries of the main terms, and then the definitive agreements out the details. So you don't want to have a binding term sheet on a lot of those provisions because they may change. They're going to be subject to a whole bunch of other issues and details and diligence. But what you do want to make sure, at least from the investor standpoint, the investor wants to make sure that if there's a no shop, that there is a no shop, that you can't just go down the street and try to work a better deal and come back to them and say, yeah, I'm not going to do this with you because I found someone that can do a better deal and give me a better investment. For the company side, what's really important is the confidentiality. So once you sign the term sheet, that's when diligence starts. You're going to be opening up a data room, giving access to a whole bunch of documents. Some of that may be sensitive or confidential, and you want to make sure that at that point there is confidentiality so that that investor knows that they can't just go and then open that up to someone else or disclose it. And that's going to be an important provision to be binding. And then other issues that come up, whether or not the investor is going to get a board seat on your board of directors, or whether they're going to have observer rights. An observer is basically someone that can sit in at board meetings, get access to the information that typically is provided to the board members, but they don't have a vote. They're actually they don't have any sort of say-so. They're just there to observe. They can offer input and advice, but they don't actually have a vote as a director does. Next slide, please. So when we talk about the documents involved in a venture capital financing, we talked about the term sheet. There'll be the diligence process that starts right once the term sheet's signed. You want to be prepared for that. If you're on the company side, make sure you've got everything ready to go before you ever sign the term sheet. Because once the term sheet's signed, you want to basically drive to getting your transaction closed as quickly as possible. It may take 30 days, it may take 60 days, in some cases longer, but a decent range for a typical, not overly complicated transaction, Series C, Series A, you can anticipate anywhere from about 30 to 60 days, give or take. But in order for that to go smoothly, make sure everything's ready. You've got a data room that's set up. The documents are organized. They're organized in a way that investors would typically want to see them. Oftentimes, the setup of the data room is done in conjunction with a list that is sent to you from the investor or investor's counsel called the due diligence request list. It's basically a request for a whole bunch of information and documents, and it's usually itemized and it's pretty detailed. So if you haven't set up your data room, once you get that list, that's a good time to set it up, because if you set it up exactly the way that they're asking for documents, then it's super easy for them to go in, check the box to see what they reviewed and go through that process a little bit quicker. On the documentation side of things, I mentioned there's a suite of documents that typically a VC deal will have. You can find really good model forms at the website that's listed under NVCA. So it's the National Venture Capital Association. It's a trade organization that was created a number of years ago, really designed to help the investment community, both investors, the lawyers, and the company and their lawyers. So they've created over the years a really fantastic set of model documents that essentially is used in almost every deal. I mean, if I had to pin a percentage on it, I'd probably say 85 plus, maybe 90% of the venture capital financings done in the US are done using these model forms. So that's oftentimes the first starting point when you start a deal. Is those are the documents you'll go to. You'll pull them down from the website and update them, and then start negotiating and tailoring them for your particular deal. So that's a really good resource. There is another set called Series Seed, which is available at that website there, seriesseed.com. They're shorter, a little bit more truncated, don't include as many of the provisions. They were designed essentially for smaller rounds where you didn't want the full-blown NVCA style documents, but still wanted to make sure you've got a set of documents that can be appropriate to use for a venture capital type financing. Don't see that too often, occasionally, but not as common. And then proprietary forms. So oftentimes law firms will have their own forms that they've created over time, whether they're based on the NVCA model or whether they're based on the Series Seed or some other form. You'll see those from time to time as well. The pre-closing process is sort of everything that comes into play before the closing. Everything that needs to happen, all the consents that need to be obtained from the board, from the stockholders. Are there other stakeholders that you need consent from? Do you have everything, the documents are ready? Are there ancillary documents that need to be put into place? All of that is what I typically look at the pre-closing, and making sure you've got all that done. And if there's anything that's going to take time, that you make sure you plan for it in advance, so you're not, delayed because you needed to get something done as a pre-closing item that you waited to the last minute to do. Closing essentially is when all the documents are done, the investors have signed, the company is signed, everyone's ready to close and wire funds, and everything that's required for closing has been taken care of. And then essentially the closing happens when documents are exchanged, signatures, and the wiring of the funds takes place. Then you can consider the deal closed. And then there might be some post-closing items, notices that need to be provided to shareholders of actions. If particular shareholders didn't vote on a transaction, there'll be securities filings that need to be taken care of as well, which typically the attorneys will handle. And there could be some other post-closing items that either the company needs to take care of or the investors require be done after closing. Next slide, please. So I know we're almost at the hour. So let's talk a little bit about getting investment ready. Looking at sort of preparation as being a really key component here. Getting yourself investment ready well in advance is going to be tremendously helpful for you. So again, I'm repeating a little bit of what I said earlier, but making sure you've got clean company records, documented, signed, dated, everything stored in a data room or easy to access. It's named appropriately. Make sure you've got proper documentation orders. So you've got all your CIIAAs or PIIAs, as you remember from earlier, those acronyms: confidentiality, invention assignment agreements. You've got your vesting agreements, your stock transfer restriction agreements in place. You've got a cap table that's really important. Make sure you've got a cap table. There are great cloud-based companies that provide cap table services. There's a whole bunch of them. CART is one that's very well known. There's Astrel, there's a number of others. So find one of those. I oftentimes recommend doing it because it's easy. It's electronic. You don't need to worry about printing stock certificates. You get everything, all the data up into those programs, and those programs will then, you'll be able to go in and print out a cap table. Oftentimes you can run models. You can do 490 evaluations. You can easily go then and issue stock, issue warrants, issue options. It makes it really easy to manage the cap table. And there's a lot of other bells and whistles a lot of those companies have, they provide too. So certainly worth checking out. Set up a data room. So oftentimes for our clients, when we have a client that asks us to help form the company or wants to do a round, oftentimes we'll create a data room for them. We have our own data room style that we use, and we organize it in the way that we've seen over the years. Investors are typically looking at how things typically are organized. So it makes it very easy. And then we upload the documents as we're working on stuff. So generally speaking, the data room's in a pretty good current position. So then when you get to do a financing, it's very easy. We double check it, make sure it's updated, and then it can be turned open to investors. Create and maintain the information that will be needed for investors, diligence. So just understanding the kind of things that investors are looking for. We've kind of covered most of that so far, but just being aware of those documents and how important they are, making sure they're there, easy for investors to be able to review. And then becoming familiar with the NVCA model forms, because more likely than not, when you get to do your first financing round, those are the forms you're going to be starting with. So, take some time, read them, understand them, ask questions. The more familiar you are as a founder, or if you're on the management team of a company, the better, because it'll be that much easier to work with your attorneys to make sure you run through all the process appropriately. It'll be really, really helpful. Next slide, please. So I'll take a couple more minutes, and then we should still have plenty of time for questions. So this is sort of a mantra you hear a lot from corporate attorneys, this sort of ABC concept of always be closing. So whatever you're doing, when you've got a financing, the mantra or the mindset should be, what am I doing to get to closing? What am I doing today to get this deal to close? So always be closing. So do your homework, get your company's house in order before you talk to investors. That we talked about the cap table. We didn't talk too much about a pro forma, but essentially a pro forma is when you've got an investment, you got a term sheet. One of the things that even before you sign the term sheet, what you should do is create a pro forma. And it's basically you take your cap table and then you project out what that cap table is going to look like when you take on this new investment. So you can calculate the number of shares that'll be issued, what the percentages will be, what the dilution is going to be for the founders and if you have other existing shareholders, you can figure out the dilution that's going to happen to them as well. But it's where you'll look to see what it's going to look like, before the transaction, before the financing, but importantly, what it'll look like after you close on your financing. So it's going to be really important because not only for the company, but the investors are going to want to see that too. So they're going to want to know that, okay, I'm putting in $1 million or 5 or 10 million, and the term sheet says, the documents say I'm going to be getting 15% of the company. Then I need to make sure that the pro forma is done and the calculations work out so that the number of shares that I'm going to be issued will equal that 15% or 20% or whatever they're expecting. And you want to make sure that's done. It includes some time to go through and make sure that the cells are all formulated properly, so the numbers flow, the calculations are done appropriately. That's a really critical piece because it's not anything that gets signed. It's not an agreement, but it's a important document that everyone's going to be looking at to make sure that the numbers and the percentages and the investment amounts are all correct, because then once you've signed off on that, those numbers are then taken and populated into the documents. So where there are numbers referenced in the documents, that all comes from the pro forma, which has been fully validated and reviewed and approved by everyone who's involved in the transaction. We talked about data rooms, doing your diligence on potential investors. Make sure you know your investors, know the kind of investments they've done, know as much as you can about the VC firm, the managers of the VC firm, their experience, their knowledge, their background, but also know, is this type of investor, this VC, an investor that typically also invests in follow-on rounds or future rounds? So it's important because you do your first round and you're going to do another round at some point in time in the future. Is the fund that put money in your first round, are they also typically investing in subsequent rounds? And that's good to know because you then may be able to count on them on these future rounds. Some do, some don't. Some don't really have a particular set approach, but it's important to ask those sort of questions, as well as to understand where the fund is in its life cycle too. Is the fund fairly early on? Does it have a lot of capital left that if there was another financing round, that it could invest in that round? Prepare from closing from day one. We talked about that. Create your team, internal, external. So make sure as you're starting on a financing, you've got a good internal team. I mean, hopefully if it's just the 2 founders or 1 founder, then you're kind of stuck with yourself. But if you've got a little team, make sure you've got a team that's all, working together, aligned. There's good communication between the internal team and your external team, which is typically going to be your lawyers. And that communication flow is done and it's consistent, it's smooth and seamless. Set up a reasonable timeline, organize and divide tasks appropriately, make sure there's good delegation, understand who's doing what so you can process and get through and get to the closing as quickly as you can. Next slide, please. Okay, the last sort of topic, and then we'll open up for some questions, is just common pitfalls. I'm going to go through quickly on these, but we talked about a few of these: not setting up the entity properly, not having the proper documentation. We've talked about a couple of examples where that can be sort of catastrophic. Failing to own the IP that's critical to the business. I gave you an example of that. Not having proper vesting for equity grants. I gave you a bit of an example earlier on that too, where a founder gets 20% or 30% of the company. After a couple months, decides to bail, and now they walk away with 30%, and you're stuck because the company can't. There's no vesting, so you can't, repurchase those shares. Undocumented stakes in the company where you've talked about someone having a certain percentage, maybe you've given them a percentage, but then you somehow didn't translate that onto your cap table, and then it comes up later after the fact, and then it creates a big mess. Not complying with securities laws. I didn't go over this in a lot of detail, but just keep in mind that the simple, basic premise here is anytime a company sells a security, issues and sells a security, whether it's stock, whether it's an option, whether it's a warrant, whether it's a convertible note or a safe, those are all typically considered securities. There are federal laws and state securities laws that need to be complied with, because basically the only way you can sell a security in the US legally is if it's registered, which means, i.e., you went public, which no startup goes public because it's way too expensive and timely to do that. Or you get an exemption from the registration requirement where the securities laws say, look, we understand the private sector, you guys are not going to have, go public to sell your stock to a small set of investors. Doesn't make sense. We want to encourage innovation. We want to allow companies to be able to grow. You got to sell equity to do that. So we're going to give you some exemptions where we're not going to require you to register your stock, but you can sell it as long as you've got an exemption, both at the federal level and then depending on where the states are that you're selling the securities to. So just making sure you've got your attorney there, they can guide you through the process and do the filings and all that. That's important. Not managing the cap table, we talked about that. Not having clean corporate records. Don't use standard boilerplate documents. If you're not a lawyer and experienced in this stuff, if you go to Google and find some stock purchase agreement and you download it and use it, you're doing that at your own peril because it may have provisions in that they're absolutely not the right provisions, and you may be shooting yourself in the foot. Get a good lawyer that does this kind of work involved to help you. Honestly, you'll save a ton of money and headaches doing so. I'm not going to go through the other stuff. I want to make sure we open up for questions. But just remember, there's a lot of stuff that needs to be done. For the lawyers that do this kind of stuff on a day-to-day basis, we'll help you and guide you through the whole process so you don't have to worry about it. You can focus on the business. Okay, so I think let's go to the next slide. Yeah, just a couple parting thoughts. Do your homework, prepare in advance. And so let's open it up for Q&A. Yeah, dream backwards is something a friend of mine once told me, which I thought was kind of a catchy term. So, imagine your end goal, where you want to be. That's your vision, that's your mission, and then work backwards to achieve that. That is essentially what it means. Next slide. Okay, so here are my contact information. Feel free to email me. If there are any questions, I know there was a bunch of questions about the recording and the slides, all that'll be made available. We'll get that out as quickly as we can. My contact information is there, so if you want to reach out, certainly feel free to do so. Let me see, I think we've got a few questions coming up. Okay, so someone asked, they have a Canadian company looking for investors from VCs in the US. Will Canadian documents be good enough? Great question. So I do see this come up oftentimes where, some investors, some VCs are very experienced investing in non-US entities. And if that's the case and they've got that experience, then yeah, that should not be a problem. The good thing about Canada is Canada and the US is a very good relationship. So we have similar legal systems. So it's not a far stretch if the VC is familiar with Canadian ventures, they've invested in Canadian companies before, then typically it's not going to be a problem. I will tell you though that some VCs in the US that don't invest in foreign companies, they typically will want to have a US company, and they will typically expect the documents to be US based type documents. So just food for thought there. Okay, so views. Can you share your views on crowdfunding, crowd investing, which has become popular in the last few years? Yes, it's definitely become very popular. And yes, since the Jobs Act was passed and they allowed for a new type of fundraising, crowdfunding, and it has become very popular. There's been a whole bunch of companies that have been set up that they essentially help handle the whole process. So I've seen it used, and I've seen it used effectively. The one thing I'll tell you, if you're talking about getting VC financing in the future, some of the VC firms don't like the crowdfunding. And the reason why is because when you go out to do a crowdfunding, you're basically opening up and taking investments from a much wider audience, if you will. So you might go out and ask for $5,000 or $10,000 checks from, or even smaller checks from a whole bunch of people, as opposed to larger checks from a smaller group. So the takeaway is anytime you've got a whole bunch of people on your cap table, a whole bunch of people that have invested money, it just increases the burden on the company, because now you've got a whole bunch of stakeholders that have maybe some say so, or can ask questions, can reach out with issues, more likely that someone might be upset about something. It just, anytime you've got more people involved, there's more of a chance of there being issues. So for that reason, it's oftentimes not looked upon too favorably by VCs, just because they know that, okay, great, I'm investing in a company that's got a huge cap table. There's 200 or 300 shareholders. So every time the company's going to do something, you got to be mindful of that. And if someone's got an issue because they're not sophisticated, they can raise claims and it can just be a bit of a problem. I don't want to deal with it. I want to have a smaller cap table and people that are more sophisticated, like me, the VC fund, so I don't have those issues. So that's one thought process that goes through. I've seen that be an issue with crowdfunding. The other thing is making sure that if you do crowdfunding, definitely make sure you do it properly. You need to make sure you're complying with all the securities laws. There are different things you need to do if you're doing crowdfunding versus just your traditional non-crowdfunding with regard to the exemption. So just be aware of that. Another question about you. So similar question about like the Canadian investment, but now with the UK. And same answer. I mean, UK obviously is a very well-known place. There's a lot of investment money there, a lot of VC firms in the UK. And there's definitely a lot of investments cross-border, both UK and US. But I guess that, the short takeaway is the same thing. If the VC funds are familiar with UK entities, then they won't have any problem investing. But if they're not, then they're going to want to see a US entity that they invest in. What are some key factors for investors to seek? In your startup? Yeah, that's a great point. And I didn't cover that, but really quickly. So think of it this way: they're investing to make money. That's their mission. They're making money for the people that have invested with them. They've got to return an investment. And when you think about the numbers, the stats, so for it changes, but it's anywhere from 1 out of 10 to 1 out of 15, maybe, companies that the VCs invest with will hit it out of the ballpark and return a huge investment. And that 1 or 2 out of 10 or out of 15 is typically what carries and makes the profit for all the other investments that don't work. So the majority of investments fail. They don't return an investment they don't return an investment for the investor. So given that, they need to be really selective and really need to know that the company is one that can scale and grow and be a sizable company with enough value so that if it isn't a candidate for an exit, an acquisition or for going public, that it's going to be able to do so and be successful at it. So it's got to be a scalable type of business. The other factors that are key that look at is they look at the technology. It's got to be technology that's going to be commercialable, that can get out there and can solve some sort of need that there's going to be a market for it. And the market needs to be big enough, but it's the kind of technology that can service that and solve that solution, provide that solution for that need. The other key is the management team that they have confidence in, that's going to be able to do what is needed to be done to get the company to the next level. The initial management team may not be the management team that will be with it long term. Oftentimes it's not. As a company scales and grows, it's going to get to a point in size where you need to bring in people that are used to managing, have a lot of experience managing a larger enterprise. It's very different managing a company that's got 10 or 20 employees versus a company that's got 400 or 500 employees. So you need to bring those skill sets in, but it is critical. They're going to be looking at the founders, looking at the management team that you have in place, and making sure that they're the kind of team, the kind of people that they want to invest their money in and work with. Because just like you should be looking at them as, hey, is this investor someone I want to work with? Do I enjoy them? Do I enjoy working with them? They're going to be doing the same thing. And if they like you, they get a good feeling about you, you're easy to work with, that goes a long way towards their decision making. Okay, so let's okay. Okay. What pro forma projections are expected to reach a Series A investment? So if you're talking about sort of revenue, what is typically looked at by VCs for sort of your typical Series A, or what gets them interested in your company? If on the revenue side, if you can get to 1 million in annual recurring revenue, that's oftentimes sort of a threshold that you'll see talked about with VCs. It doesn't apply to every VC because, again, you need to know the investor, you need to know the VC, and you need to know what type of investments they typically make. There are some VCs that look at making very early stage investments in companies where there is no revenue. They know that and they're comfortable with that, and they want to get in early on those types of investments. There are other companies, other VC funds that want to see some sort of revenue coming in on an annual basis. So, whether it's $1 million or $2 million, $1 million is what I typically have seen and heard around the community. So that's a good a threshold, because then they know at least you've got $1 million coming in, you've done something right, you've got recurring customers that are paying for services. So that's always a good sign. That's one of the things that I'll see. Crowdfunding investors usually act as one single person at the cap table, I thought. No. Well, so if you're going to do crowdfunding, basically what you do is oftentimes there's companies, not lawyers do it too, but there are companies you can go to and say, hey, I want to do crowdfunding, and they've got a whole platform designed to help you with your crowdfunding. So what they do is they get you all the information, they gather all the information, you get all the documents in place, you upload them to their platform, and then they can go ahead and send it out, or send out notices and do the mailings and the general solicitation, the advertising, if you will. And then the investments come in, but it's going to be investments from a whole bunch of different people. They're going to be individual investors or entities that are investing, but they're all going to be investing and buying a piece of the company. They're going to be getting shares. So it's not typically one person. It's a whole bunch of people. Now, there may be another circumstance where you go out to a company that was set up kind of like a VC fund, right? A VC fund is essentially, it's a company that was set up. You get a whole bunch of individuals that invest in the fund, and then the fund goes and invests that money into a startup. But the typical one that I've seen is where the crowdfunding is you go out to a whole bunch of people and they all send you checks and they get small pieces of the company, so you end up with a larger cap table. Okay, so here's something it looks like I'm not looking at questions posted on Q&A. Okay, so let me look at the Q&A. So there's a bunch of questions that were posted in the chat, and I'm looking at the Q&A. I don't see anything in the Q&A, but oh, here we go. Okay, let me run through some of these too. So what happens if an investment fails? Would the founders receive a lawsuit? Potentially. I mean, that's a really open-ended question. I don't know, the reasoning why it failed. If the founders took the money and went on vacations and spent the money, or were really making bad, negligent decisions, defrauding the company, doing something bad where they could be held accountable, then yes, they could certainly be sued. But generally speaking, if they used good efforts, if they discharged their duties properly, they made the best decisions at the time with the information they had, tried to do right by the company, and the company just didn't succeed, then yeah, there can always be a lawsuit filed, but typically the founders as individuals will be shielded because they've set up the corporation that provides this liability protection, it provides a shield. The only time they can be sued individually is if they stepped outside of their role, as let's say as a director and officer, and did something that was outside and beyond of what they should have been doing, or they engage in something where they could be personally held responsible, like engaging in fraud or doing something along those lines. Important point with that, though, is oftentimes you'll want to make sure you get director and officer insurance, errors and omissions insurance, to cover scenarios where individual board members or officers could be sued. There is insurance. It's generally not too expensive. Someone posted something saying it's too expensive for small companies. I totally disagree. We do that all the time. You're not typically looking at a huge amount. It could be a couple $1,000s a year, but it could be money well worth it. And small companies do have boards. I mean, if you set up a corporation, you have to set up a board. You cannot have a corporation, at least in the US, without a board of directors, because the board is what sort of manages overall the company. And then the officers manage a sort of day-to-day, they're the management team, if you will. Okay, so how does it work if co-founders decide to adjust or redefine their equity ownership in the company, since it was 50-50 when they founded the company? That's a discussion they're going to have. I mean, if the company was set up as a 50-50 and somewhere along the line they wanted to make a change to it, then they're going to need to figure out what that change is. And there's probably a couple of ways that could be done. One founder could transfer some of his or her shares to the other founder to equalize it to the point where they want it to be, or the company could issue additional securities or equity to that one founder that's supposed to get more. It'll dilute the other founder, so that's another way of doing it. So there's a couple of different ways of doing it, but yeah, it certainly can be done. Okay, so I didn't see any. I saw those questions in the Q&A. I didn't see anything else. Let me go back to the chat. Okay, so all right, there's a bunch in the chat. Let me see if I can run through these in the next 10 minutes. Okay, we are a SaaS-based ecosystem company from India, building in the marketing space. We outreached 100 plus US investors and got less than 5 responses. We were looking at 100 to 500 seed round. Can you give some input on improving the reply? Any resource or specific process you recommend? That's a really good question, and happy to kind of talk with you offline about that. I think looking at sort of the basics of what's your approach been, who are you reaching out to, is your slide deck set up in a way that it's as attractive as possible and it gives all the information that investors are going to want to see. Investors in the U.S. maybe a different perspective in India if you're talking to investors in India, but for the U.S. market, there's sort of a rhyme and rhythm in how you present information. So making sure you're doing that in a way that is most receptive to investors here in the U.S. would be a good thing. The other thing to be aware of, and I won't go into too much detail, but just be careful and talk to a lawyer about how you go about looking for investments. If you go out to a whole bunch of people that you don't know, don't have a relationship with, and you start asking them for money to invest in your company, you now could have actually engaged in what's considered a general solicitation, which is governed under the securities laws. And you can't do that unless you've got a proper exemption and know how to do that. So i.e. like a crowdfunding, which allows you to do some advertising and some sort of general solicitation, but it's done in a way that's compliant. If you're not complying with the securities laws, you can get yourself into some trouble. So just be aware of that. But definitely work with a lawyer who understands that. Any advice on pushing back on unfavorable terms by investors? Well, I think the best way to do it is just come as prepared as you possibly can. Investors they're typically sharp. They know the terms, they know the investments, and so you're generally speaking going to be at a disadvantage because that's their world that they live in every day. So how do you counteract that, or how do you sort of equalize that playing field? The way you do it is just by being as prepared as you possibly can be before you go in to discuss, negotiate a term sheet or any of the agreements. So a couple of things is do your homework, read, talk to people, get advice. But before you go in to actually negotiate anything, get a good lawyer that understands these types of deals, works with startups, works with VC financing to help you, because you can read everything you want and spend a ton of time doing it. But again, if you're not doing this every day like the lawyers are, you're just not going to understand it that sort of depth of level that you need to. So doing a lot of yourself to prepare, and also understanding and getting help from lawyers. So to your specific question, though, is once you've got all that information, now you've got all the arrows in your quiver, if you will, so that when somebody fires out an objection or pushes back on a particular provision you want, you've done your research. You can answer it. You can say, well, actually, that's a market term. That's a term that's pretty consistent with the market, or that's a term that's consistent with the market for health tech companies or med tech companies or whatever the case may be. You can provide a response that's intelligent, is backed up by some basis of experience, whether it's you or your attorney, or you've got some ability to hold on that position. And investors will respect that. They may not agree ultimately, but in some cases they'll respect that, and you'll be able to negotiate those terms. Could you talk about trying to reach capital before you have a revenue? What types of forecasting VCs expect? I touched on this a bit. I mean, some VCs will not invest in a pre-revenue company. It's just not their model. They don't like it. They don't do that. But there are plenty of investors that do. I mean, we've done a ton of investments with companies early stage that had no revenue. So there's a lot of investment firms out there that invest in pre-revenue. So if it's pre-revenue, then excuse me, what you need to sell them on, and what you really need to get their interest on, is we've got no revenue, but we've got great technology. We know the market. We know there's a fit in the market for our technology, and it's going to be a big place that we can play in this market, and we can generate revenue that'll be substantial, that will then return the investment on your investment on your investment to to a large extent. So you can convince them that. I mean, again, they'll know the technology if they know the industry, and if they play in your space, they'll know it. So they'll be able to get it quickly. You just need to explain it to them. The revenues are not there, but so what? The revenues will be there. What you've got is you've got technology that solves a pressing need, and there's a great market, and it's the type of technology and company that can scale and grow large and end up returning an investment for the VC. What kind of salary payment should I set up for my company, and how high is a good rate? That's a great question. It's hard to say. It varies by industry to industry. It varies big by geography. So what someone may be able to pay themselves in San Francisco or Silicon Valley may be very different than what you might expect could be paid to someone in Alabama or Nebraska or one of the other states where the cost of living is a lot less. So you have to kind of look at what's market in the area in which you're going to be working in. And then you also need to balance that against, right now the company needs money, and the money needs to be used to develop the technology, develop the product, develop the service, whatever it is you're creating. So I need to be able to put as much of that towards developing the company, because if I pay myself, as soon as money comes in the door, if I start paying myself a lot, then there's less money to build a company. And that's always that's a tension point that almost every startup deals with, unless it's independently funded and you've got enough to bootstrap it. So you just need to balance that out. I mean, giving yourself some salary to make sure you can, continue to work and you don't have to be stressed out, but making sure you're preserving enough for the company to be able to grow until you get your funding that can really accelerate the growth is going to be critical. So there are resources you can reach out to kind of get what wages are in different areas and different industries. I would encourage you to do some research there and find out. That'll give you a decent sense of sort of salary metrics, if you will. And then you can kind of peg it to that, maybe down a little bit from that, given that you're early stage and don't have the resources yet to pay the full amount. Okay, we got a couple more minutes. Let me see how many more I can get through. Yeah, so one comment coming in, we're launching an AI medtech. We do a ton of work in the AI space and the medtech space. So yeah, reach out to me. Would love to talk with you privately. Typically, out of every 1,000 companies pitching for VC money get funded. Yeah, I don't know that stat, but I kind of gave you what, yeah, it's tough. I mean, it's a competition. So that's why you need to make sure everything's honed. The pitch is really well rehearsed and presented, and it hits all the topics that the VCs are interested in. I have several projects, web applications. Would you say it's okay to have them all in one entity, or would it be beneficial to set up in different entities? I get this question a lot, actually, and what I oftentimes say is, if it's all the same type of business you're doing, maybe it's a little bit different here and there. But if it's all going to be related to the same thing, then maybe it makes sense to have it under one company, because investors are going to be looking at that, right? So if you've got a company that is doing essentially the same type of business, maybe some nuances, differences, but you've set up one in one company and you've set up the other type of service that's very similar in another company, and then you go out for company A to raise money, but you've got this company B, you're going to have to disclose that you've got another company that's doing something very similar, because it's potentially competitive, and the investors are going to want to know that. So as soon as you tell the investors that, they're going to say, well, if it's so similar, why is it not in the same company? I want to invest in one company that's going to be able to grow. This is a similar enough business. Why isn't it in the same company? You may get that kind of question from the investor. So if that's the case, I'd probably say have it in one company. If it's different enough, so for example, one business is really a service business. It's a consulting business that you have. And then you've got another company that you're building, which is technology based, that's going to offer a technology solution that doesn't provide the consulting piece. That may be a scenario where it's okay to separate out the company. So you can continue to run your consulting business, grow that, drive revenue from it, so you can pay yourself a salary and all that. Whereas the other company that's got the technology could then grow and scale and take on investment dollars. And that may not be enough of a conflict or competition that the investors are going to be worried about. It's a case-by-case basis, but that's at least a good example where I've seen a division of two different companies be done and been acceptable to investors. What's the best approach for an entrepreneur to take in the given market? Great question in today's market. So be patient. Deals are taking longer. The diligence is taking, I don't know that I'd say it's taking longer, but investors are being more careful in their investments. They're taking more time to look a little bit more in depth at the companies they're investing in, just because of the fact that there's been some rather notable newsworthy debacles and implosions of companies where maybe there wasn't as much diligence as there could have been, or things were missed, and suddenly it turns out that the company imploded, and had the investors known, they maybe wouldn't have invested. And I think that makes the investment community always a little bit more careful. So I think you can expect diligence to be a little bit more in depth, maybe take a little bit longer, maybe more information requested, deals taking maybe a little bit longer to close, maybe investors being a little bit more careful and selective with companies they invest in. So whereas before, maybe, 2 out of 10 or 2 out of 50 or whatever investments they would make, maybe there's a little bit less now, or maybe the metrics are a little bit different. So just being a little bit more careful in the investments they're making. Okay, so I think I answered all the questions. If I missed any, please reach out to me separately. Would be happy to chat with you. We're a minute over 10:30. I know it's an hour and a half, so it's a long day for everyone to take out an hour and a half to listen to this presentation. So thank you. I'm very grateful for the fact that everyone joined. Hopefully the information that I provided was helpful. If you have any follow-up comments, questions, please feel free to reach out to me. You've got my name and my email there, and would be happy to chat with you. If there's anything we can do to help you, we'd be happy to do that as well. So thank you very much. Hope you all have a great rest of your day, afternoon, evening, and I will be doing other presentations on different topics as well. So stay tuned. I'm sure there'll be some other ones that I'll be giving shortly. Thank you so much. Take care.